Hello, traders. It's 8:02 a.m. Chicago time on Wednesday, the 17th of March, 2021. This is episode number 1956. Thanks for joining me here again. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. Of course, always would appreciate a mic check. If I come across too loud, just let me know. Don't want to be distorted and don't want to blow out anybody's ears. This morning we have a market that is selling off slightly. We do see risk off across the board. Somehow the Dow's holding on to 46 points of gain versus yesterday's settlement, trading at 32,770, up 0.14%. The cable's up, the euro's up, and the dollar's up, which is also interesting. The dollar is pretty much unchanged, up 2.5 cents. Everything else is below board. Crude oil April contracts trading, WTI April contracts trading at 63.70, down $1.10 or 1.7%. The Nasdaq's off 144 points, 1.09%. We'll see that most of the session this evening held on to yesterday's range until about 4 a.m. Chicago time or so. And then we had a sell-off. Again, the Nasdaq's off 1%. The Russell's off 14 points, 0.6%. The bonds are off 20 ticks. Interesting. The S&P is off 13 points, 0.33%. The Bund is off also 56 ticks. And the 10-year note is off 9.5 big ticks. Silver's off 5 cents. So it's risk off everywhere, including the safety assets. So that's where that stands today. Obviously, a big day. We do have the FOMC interest rate decision today at 2 p.m. We do get crude oil inventories, EIA inventories at 10:30. So it's 10:30, then 2 o'clock FOMC rate decision, and then the presser at 2:30 p.m. Eastern time. So what's driving things this morning? The Federal Reserve is a big one. What's going on with the yield is still in play. Those of you who are at Convergent, if you watch yesterday's Trade Talk, we talk about yield and its connection with equities, and how that movement has been driving things. Futures tracking the S&P 500 and the Dow were subdued as investors held back on trades ahead of a U.S. Federal Reserve policy meeting outcome, while Nasdaq slipped as inflation concerns kept yield levels elevated. European shares slipped as most investors stayed on the sidelines. Japan's Nikkei ended down as profit-taking in the tech sector offset gains in healthcare. Gold ticked higher while the dollar was little changed. Actually, gold currently down $3.80, trading at $17.27. So this has changed since then. Oil prices fell as concerns about weaker demand in Europe outweighed an industry report that showed U.S. stockpiles unexpectedly fell last week. Building permits data is expected to be released later in the day, and it's already been released. This is from Reuters Refinitiv. So that's where we stand this morning. The overnight inventory, currently the volume in the overnight session in the S&P is at 163,000. This number is going to read very, very differently than your quote board. The quote board is combining volumes. I'm only looking at the volume in the June contract. Rollover is always making a mess of volume for good reason. But the volume overnight is 163,000, which is actually relatively low versus the recent history. 163,000. The range 25.25 points, and inventory currently is about 92% short. 92% short. The market, the S&P is in a double distribution with the point of control having shifted to the lower end of the distribution to 39.40. We'll look at that in a minute. That wraps up the summary portion. I want to bring this up here. Let's go to full screen on this. I wanted to bring this up. This is the pace of the roll, and it looks to me, based on what CME is reporting here, that the roll is complete. Really, what's remaining in the roll, however, is that participants in the options market are likely to continue to use the futures to hedge their option delta and to help peg prices to whatever strike is needed. So we're still going to see the effects of rollover and expiration well into Friday afternoon. It just goes on until the end of the day, the end of the week. It doesn't stop with expiration, which is at 8:30 Central on Friday on some products, and on some products it's at the cash close at 3 p.m. Central. We'll see the effects all the way through Friday, and it'll be cleaned up by Monday. But given how this rolled so quickly, the roll, as I said yesterday, accelerated dramatically on Tuesday to bring us to the point where we are basically done. It's achieved basically what's expected in terms of the open interest rolling into a future contract, which is around 76 to 80% of the open interest traditionally rolls. 20% is settled, it looks like, and so that's done. So we have we don't have to worry about the effects of that. And then, of course, let's take a look at our expectations yesterday. Yesterday's primary expectation is that we would likely pull back, push lower, and then break higher. And I was anticipating a touch of 75, the next key reference point up, which is a projected measured move level. And then the secondary is a push higher above the 70 area, to about 72.73 right here, 72.73. And then I was looking for an impulse down, consolidation, and I was looking for a tag of the 48. The 48 is a breakout point from the day before. That's the breakout point here. We have a stock zone at it. This is a big target below, and if it breaks through there, then I was looking for it to push through to 36-ish, which was the prior all-time high set in, I think it was set in February. February, I believe. So that's what was expected. Here's what we actually got. This is a 4-tick Renko. We opened out of range. And we had an open auction out of range. We tested up, tested down for an opening swing. We broke the opening swing to the top side, held VWAP and mid, RTH VWAP and mid, retested, pushed by 2 ticks, came back and tested into the open again, and then broke higher into 70.75, and then finally it rolled over. And here's that impulse given as scenario 2. So scenario 2 now is aiming for 48, which is down here somewhere. Scenario 2 pulls back and squeezes through the mid, which was a setup here. This right here, this was, I narrated this in the Head Trader channel. This mid was a setup, provided one scale out, and then it squeezed the rest out before actually rolling over and then finally running. So we had a neutral day down yesterday. We closed below the IB. It's not a neutral extreme, just a normal neutral day down. We pushed into 42.75, well below the 48. and then we consolidated. Yesterday was a relatively balanced day, even though it looks like two distributions. It was really pretty much a balanced day. The market basically resting and developing value above the value that was there the day before. The point of control shifted from here to here. The point of control the prior day was 39.30. The current point of control is resting at 39.64 right up here. And so we're accepting higher value. This high retest was had failed by a tick. And that's where we stand so far. We finished below full session and RTH VWAP at the full session mid, below the point of control. We finished inside of the range, and we finished right at this high volume node that was left behind from Monday. Very nondescript day. By the way, do not misread this delta. This is wrong. This was a technical issue. This is a technical issue that eliminated the prints on the offer. So lifting was taken out of the equation, and it simply reported all the sells. So all of a sudden, this shows like there was this shows that there was a ton of selling on the way up, which actually got me pretty excited. Looked like a setup here for a short. As prices climbed, delta's getting hammered, expecting this to fail and roll over, which it ultimately did, ironically. But really, this this delta here, please don't pay attention to that. That's an error in the data, and it's not going to be fixed. So even if I reload the data, it's not going to go away. It's an issue with IQ Feed's telco lines to the exchange. So that's where that stands. Let's carry that over into the overnight session. So we closed neutral day down, neutral normal, not an extreme point of control, still higher up. And then we come into the in this session, and we try to push up on the reopen, pull back. We're in the closing price area. We consolidate sideways, and then we break lower with the open of the European equity markets. European equity markets came in sellers right away, so we developed this distribution up here, and then we broke lower, and we have developed a secondary distribution and shifted the point of control lower. This is a market that is pulling back. This is a market that's pulling back into balance, into the most recent balance. It's coming back into balance. This top is likely done for a little bit here. We're opening in a gap down currently. We're trading below the prior low, and therefore the one-time framing up that we look at is starting to teeter, and so we have a rolling top and a potential for a market to continue lower. Let's look at the composite, the daily composite chart. Of course, for those of you who've been here know this, but I need to repeat it. Each bar here represents one RTH or one pit session for the S&P minis. And what we've done is we have pushed very aggressively these higher lows. We one-time framed up. We reversed the one-time framing down on the weekly, and I know I'm repeating this every single trader bite, but this is important to remember this for the narrative. We continue to push one-time framing up until last Friday, where we poked through the low, ending the one-time framing up, giving us pause, and then Monday comes in and squeezing it higher with a higher low, higher high, another high on the week, and then yesterday, higher low, higher high on a negative bar, on a selling bar. And then this morning, we're coming in and we are pushing below the low of that bar. This is a market that is slowing down, that is teetering a little bit in terms of its strength on the buy side. Coming into FOMC, this combination here is likely to what? It's likely to drive If there's any weakness at all or anything to dislike about the statement from the FOMC, it's likely to drive us right here. The last 2 weeks have balanced out in the 38.85, 38.89 area. This is a very prominent acceptance price. The volume has voted. The volume has voted, and it's voting that the 38.89 to 38.85 is fair, or was fair, for the last 2 weeks, and we've moved away from it. So as soon as we start to rotate, that becomes your main target, either on a swing basis or if it sells off fast enough. It's not that far. It's 50 points, 40 points really. Is it 50? Yeah, it's 50 points below. And that's not that far. We can have a 50-point rotation or range for the day. The current close to close sigma is 45.75. So it's not too far from that. And it's very, very possible that we end up right here. Do you all see this? Is this making sense to you in terms of what the market is trying to do and how it's proceeding? We're always answering the same questions. What has it done? What is it trying to do? How good of a job is it doing in getting there? How good of a job is it pushing higher based on yesterday's action? Not so great. It's successfully done so. Not so great. And so then the fourth question is what we trade on, and that is, what is it more likely to do next? What is it more likely to do next with us opening below yesterday's range? It is more likely to pull back a little bit to find those buyers, right? We have to advertise prices lower to find buyers. As price goes up, sellers start to become motivated. It makes sense. And so with the weekly low so high, we can expand this weekly low way down, all the way down to 38.06, over 130 points away, and still maintain a swing bias of a long, right? And so to me, there's a lot of room for repair, and the key price to repair, or to come back to, in terms of not to repair, but to come back to in terms of balance. The price of peanut butter normally is at $3 a jar. It's at $5 a jar. It looks to me like people are still consuming peanut butter because they've got to, feed their kids or whatever they do with peanut butter these days. But there are much fewer people buying them at $5 because they expect it to be $3. But when it gets down to $3, then the demand comes back in. This is simple economics, supply and demand. So the price moves back to $3 a peanut butter jar. And so you get the inventory moving. And that's the point of the market, is to find out what the excess is on the top side, low side, and what the balance is. And that's where the market likes to be, except the market that we're in has information constantly changing. The S&P 500 issues, the equity issues are constantly changing. The environment, the economics, the globe is constantly changing. And so we're constantly seeking value, and that's what keeps us traders in business. So that's basically auction market theory in a nutshell. So again, if we start to sell off, this 88.85 area is a big one to mark down in your charts. It's right underneath this 3,900 figure, the century figure, but that's where we're likely to test. But first, the first target is, of course, to the low of 39.13. Then we get into this low volume node in the 39.01 to 39.08, and then from there 38.88, 38.89 becomes key. Okay, just remember that's the narrative. Currently, where we're holding here, this is an impulse on the 30 minutes consolidation. So this is a bear flag consolidation, and the expectation is some sort of a continuation, even if it's by a tick, some sort of a continuation before it decides to continue lower, or some sort of a continuation before it decides that it's reached low enough, and then your stop is likely to be this area up here at 42 or so. and then the resistance is this area above in the 47.48. Remember the 48 from yesterday, that breakout price from this day right here. You see how it all ties together. It's kind of like it's like a quilt. So that's where we stand this morning. Let's take a look at what's expected for today. I'm going to let you go. I know I've talked a lot today, but there's some structures here I wanted to go over, and I wanted to make sure that you're learning how to fish. I figure that's why you're here, that I'm not just giving you answers, that you're able to read it for yourself on the fly so you can make money, so we can all win, right? We're all in this together. So here's where we are. We're looking at an open on the lower end of the range, expecting, because of the overnight inventory being 92% short, I'm expecting it to respond up into the overnight point of control. From where it's at 37.38, expecting 40 very quickly. I'm looking for it to respond into yesterday's low of 43, 42.75, 43, and likely poke through into the support range from yesterday, which was broken, and now resistance 48, attempt to get into this distribution and then fail. So as high up as 48, still sets up a short here, consolidate, and then we get the FOMC. And I don't know how fast it'll do this responsive buying work, but I am expecting responsive buying. We get into the FOMC and it either likes it or it does not. I'm sure our friend Jeremy Powell is going to say something that the equities market like, because, you know, pensions and all. Secondary, oh, let me mark that as scenario 1. That's scenario 1. I cannot tell you which way it'll go. I have no idea once the FOMC hits, so I just go both ways. The secondary is a very quick test up, a push into 43. We're looking for an impulse. As soon as we have an impulse on the sell side, then we are looking on this, the sell side down into 34, last week's close, and then it puts us into this thin area. There's a naked point of control back here at 30. Looking for that to be tested, and then it starts to make its way down. Now this could get us into FOMC at this point, but I'm looking for it to push into the into that 39.17 stock zone, and once we let go of the 17, we're very, very likely to get down into the century figure, and then again, long shot. I'm going to say that this is a long shot here. I don't know how to mark that at this point. We get that 88 area, 38, 88. This 88 is so big, so important. Okay, so who knows what happens here on the FOMC, but if it's not finding buyers, it is likely to slip right through this thin volume area down into 3,900, and 38.88 becomes the key test price below. Capiche? So that's what we have today. Again, keep your powder dry, protect your bullets into the FOMC. Don't try to anticipate or trade the FOMC, but it's important to understand it's going to bring volatility. Let the market play out. The FOMC generally resolves itself in 3 waves. We have the first wave, then we have the counter wave, and then we have the real move. Generally, that's how it plays. We have the first wave, counter move, and then the real move. It generally plays in 3s. This is a rule of thumb. Past performance is not necessarily indicative of future results, but that's how it plays out. Go get them. We only have 3 minutes of the open. Good luck. I hope you gained something today. Take care.